Now, welcome on board Kunal Vora, head of India Equity Research at BNP Paribas India, joining in on the show right now. Kunal, hi, good morning. Good to have you on the show. Kunal, one thing settles down, that's crude, and that seems like it's behind us. But the wait for FIIs and FPI inflows continues, and now you've got the big litmus test. Monsoon on one hand and earnings on the other. What is it that you're making of the market construct right now?
No, it's getting better. Thanks for having me. So compared to where we were, say 2 months back, market construct is looking better. Crude at 70, 75 is a big relief. It has positive implications on earnings, forex, interest rates, government's fiscal position, all of that. So that's a big relief. Yes, El Nino and weather is a risk to watch out for. Like June has not been great in terms of the kind of deficit which we had, and El Nino, the probability seems very high. But it's a much smaller compared to what we were seeing earlier, which was elevated crude. Along with that, even from a FI selling perspective, we've seen some easing in the last fortnight, and good reasons for that. Compared to, like, say, when crude was $100 plus, right now, the reason to sell has reduced. Valuations have become slightly more attractive. Earnings outlook also is improving now, with crude getting back to more normalized levels. So yeah, the market setup has certainly improved in the last few weeks.
Yeah, absolutely. But I'm wondering what the earnings season, Kunal, this time is going to throw up, because this is the quarter where the real impact of the West Asia war is going to be felt. I mean, just on the sidelines of what we've heard from KPIT yesterday, for instance. And, some of these skeletons in the closet are going to come out, if you will, for the lack of a better phrase. Where is it that you're expecting the most negative surprises to come by from the earnings ahead?
So earnings this quarter will be a reflection of the problems which we saw last quarter. I would not really extrapolate that as the one which will continue. If I think about like the crude impact which you had in the last quarter, good thing is it's been short-lived. You had in the past instances where crude went up and remained elevated for a long time, which was in 11, 12, 13 period, and at that time the impact on the impact on earnings was more lasting. While we also saw an impact in 21, 22 where it went up a little bit and then came off quickly. So we are looking at that kind of a setup, which will mean that your second half FY27 or FY28 earnings, based on which we look at the valuations, they will not really get impacted. On this quarter itself, yes, there will be impact because of both commodity and currency, especially on the consumption-oriented names like consumer staples will see an impact, automobiles will see an impact, but it's going to be a short-lived impact, which is a positive. And if I think about where we were, how we are thinking about earnings for FY28 earlier, and how we are thinking about it now, no, not much of a change, because this has become more of a temporary phenomenon instead of like long-term headwind.
Okay. Kunal, the consensus buy at this point, I mean, no matter who we speak with, and by the way, this is Harsh, we're interacting for the first time. So the consensus buy currently is financials and lending financials. How are you seeing that pocket?
We as well like it. Financials, especially private sector banks, continues to remain one of our preferred sectors. We do believe that this is a sector which will see the biggest delta, or one of the biggest delta, in terms of earnings after a subdued FY26. In FY27, we are penciling in earnings growth of anywhere between 15 to 18% for frontline private sector banks. Along with that, valuations, whether I look at on a PE basis, price to book basis, or compared to their history, they are looking pretty supportive. So certainly a pocket which we continue to see interest in. One of the reasons why they've not really done well is high foreign ownership and heavy FII selling. We do believe that that's something which got front-loaded this year. March to like all the way till mid-June, we saw very heavy selling from FIIs. And if the worst of that is behind, I would expect even from a flows perspective, private sector banks to be like well supported.
Is it really though, Kunal? That's the question. Is the major chunk of the selling behind us? And what would make the FPI money come back?
What I believe is India does not really need FPI money to come back in a big way. What we need is lack of selling. What we saw in March was very, very heavy selling, $15 billion. April, May, June, we've seen another $4 to $5 of monthly selling. This is unprecedented. We've not really seen this level of selling in the past. So what needs is that just eases, and I believe there are reasons for that to happen. The crude is now settled. Global AI trade has played out in a big way. Indian earnings outlook, especially the frontline sectors, starting with banks, consumption, autos, is looking better compared to what's been the case. Valuations are much better compared to what we've seen in the past. So, incremental FII selling, I would expect is ease, and in that case, domestic money can do the heavy lifting, is how we see it.
Ideas, Kunal. Where is it that risk reward is most favorable at this point of time? How much of the earnings risk goes away because of crude falling and falling so sharply?
Yeah. So as I mentioned, like banks is something which we like. We also like consumption, especially like consumer staples. After a long time, you turned positive after the GST rate cut. We believe that that's a sector which will see a healthy demand as well as price hikes which have been taken. There is going to be a temporary impact this quarter because of higher crude, but by second half of FY 27, like that starts going away. Valuations again there are like better compared to what we've seen for last like say almost 10 years now. So that's something which we like. We like telecoms as well. Continue to believe that there will be a tariff hike in the coming quarters. And that's a sector which continues to see very strong pricing power. Every couple of years, we've seen price hikes being taken, and demand for that service remains fairly resilient. Uh, these are like say top buys. I mean, like technically, we also believe that consumer durables could do well with the weather issue which we have right now. On the negative side, like we have pharmaceuticals, which continues to look expensive, much higher compared to the history and the numbers which are coming out, and even the commentary has not really been great. So that's something which we believe could remain, could like might underperform the market. Utilities have been fairly resilient. It was a good place to hide during the period of conflict, but now with the market recovering, we believe that's something which could underperform. Automobiles is something which has done well after the GST rate cut, and the Bs will start catching up, and there could be some margin pressure there. So that's something which we believe could underperform as things move forward.
I'm curious to know what your view, Kunal, is on IT services and some of the plays as well thereof. And does it seem like a large chunk of at least the valuation correction could be behind us? I mean, is the risk reward now in favor of perhaps nibbling into IT, or do you think that would be a foolish call, given that structurally, things seem to be going all right with the sector?
Yeah, that's a tough one, but what we believe is the dividend yields are looking fairly attractive. It's getting to a stage where they start beating FDs now. And then the question becomes more of growth. Our view is that while the growth rates will be lower compared to what we've seen, we don't expect this sector to start degrowing. So yeah, I mean, but yeah, terminal value is where the question marks are coming. Terminal growth rate assumptions, which we had earlier versus where the expectations are now, have changed, and they are changing with every passing announcement on the AI front. So yeah, this is a sector which is more of a value call and a hope play that things bottom out, because this does have implications on other areas as well. I mean, like, see, this also has implications on discretionary consumption in India in the longer term, because IT is one of the key generators of jobs. If I look at NSE 500 businesses, almost one third of wage cost comes from IT services. So slowdown in IT jobs and IT wages is something which has implications, broader implications for India beyond IT services.
But Kunal, so you're saying you don't see degrowth here, but how should one assess valuations therefore? Accenture trades at single digit PE. You've got our own companies trading at 15 times plus in terms of the price to earnings multiple. So the PEG ratio really isn't that attractive even at the mid cap and small cap end. How do you therefore play this, and how do you justify the valuation differential versus global peers?
So valuation in India, if you look at any sector, is very different compared to what you will see overseas. So if I look at like even consumer staples, our valuations are much higher. If I look at like capital goods or banks, across sector, Indian valuations are higher, and that's also a factor of the demand supply which we have in India. We have in India captive money, which is chasing stocks. And there is a reason why, I mean, like say IT also trades at a slight premium compared to what you see globally. And it's not really a single sector, but it's been a phenomenon which we see across the market. But
And therefore,
valuations are
should you be
looking better.
concerned?
Not really. I mean, like, say, I would expect this to continue. Indian valuations across the board are higher, and that alone will not be a reason. I mean, like, say, IT will be driven by its own IT-specific factors. And AI is really a key factor to watch out for. Like, we've seen weakness for last 3 years now, and we are hoping that eventually implementation projects will come, and Indian IT companies will have a role there. But whether that will be good enough to drive a recovery in growth is something which we'll have to watch out for.
Uh, Kunal, I mean, you very correctly put it that Indian valuations are higher. What then keeps you constructive that FIIs will probably come back at some point of time in this financial year?
So what we are banking on is domestic money to drive the market, not FIIs driving the market. What we saw in the last 4 months was $30 billion of FIIs selling. And what if close? That's enough for Indian markets to do well. It's not well in the sense that you'll start seeing massive returns, but it's more about returns which are linked with earnings. So if you have an earnings outlook of mid-teens earnings growth in FY27 and like say even low teens in FY28, which seems achievable, returns could follow that if you have easing of FI selling. I would not really expect big FI buying coming in the next few quarters because yeah, I mean like as you mentioned, valuations in India are expensive, and that's not something which is like changed dramatically. India it's become slightly more attractive compared to what it used to be, but it's not really that India is the cheapest market even now.
And, among everything that's playing out in Indian markets, with regard to mid caps and small caps in particular, the rally has been stupendous. Earnings growth has been fairly healthy. Premiums justified, you believe? Can this continue?
The mid caps and small caps have benefited from the fact that there was no heavy FI ownership. FI ownership was disproportionate in the large caps. Similarly, if I look at from domestic flows perspective, a lot more money was coming into mid and small caps where there was momentum. So they have become a lot more expensive, or the premium compared to large caps has increased meaningfully for mid and small caps. And what we see is a lot more value in the large cap space compared to mid and small caps right now, where there is still some froth which could get corrected.
Quite interesting. Kunal, thank you so much for your time today. Good to be speaking with you.
Thank you. Thanks for having me.
Okay, very